Is it better to invest in stocks of founder-led companies? We spoke to top analysts and investors to get their take. Coming up in this video, we'll share those exclusive details, plus a list of stocks they like because of the founder factor. So hit that subscribe button and let's dive in to this week's Ticker Take.
Hey, John.
Hey, Caroline.
We get a lot of suggestions from viewers,
We definitely do. Most of our videos are based on the questions that you pose to us.
which includes today's video about founder-led companies.
Yeah. Do you get better stock performance if a founder is in charge?
Which is a great question because founders dominate the world's rich list.
You think about it, Elon Musk and Jeff Bezos, Bill Gates, the Google guys, Larry Page and Sergey Brin, a lot of their net worth is tied to the fact that they had stocks that rose in value, which means that there are other people that went along for that ride as shareholders.
And Harvard did a study about a decade ago about founder businesses beating the returns of those managed by professional CEOs.
Yeah, they looked at performance from 1990 for the next 25 years, and they found on average that the founder-led businesses had total returns that were more than 3 times the average other companies in the S&P 500.
And they said it was because, number one, founders are good at keeping their company focused on their mission. Number two, obsessed with execution. And number three, having an owner's mentality.
Being accountable. Yeah, for sure. Those are all good reasons. Doesn't necessarily always mean that a founder-led company is the best for your portfolio. We spoke to longtime investor Norman Levine, who remembers investing early in a lot of companies that then struggled to grow. Have a listen.
The question then becomes, is the entrepreneur who started this business and took it to a certain level, are they able to then take it to the next level? And this is where a lot of entrepreneurs fall apart because the skills they have to start a business and to grow it to a certain stage don't exist to make it to the next level.
And another factor to be mindful of with founders, sometimes if they get older, they might lose a pep in their step. And also sometimes founders get their families involved. That can work. Sometimes it doesn't work.
And we also can't take credit away from CEOs. Steve Jobs did an incredible job as a founder, but Tim Cook knocked it out of the park as CEO.
Very true. So those are the balancing scales of founders versus non-founders. We spoke to some great investors and analysts about founder-led businesses they like and why. Should we get to that list?
Let's do it. But first, please subscribe and a friendly reminder.
This is not financial advice.
In alphabetical order, stock number 1, Alimentation Couche-Tard.
Well, Couche-Tard, the convenience store operator, comes first, in part because of the alphabetic ordering here, but also it is a stock that was recommended by 2 savvy investors who we spoke to for this video, starting with Donny of Goodreid Investment Counsel.
The company was founded in 1980 by Alain Bouchard and started with a single convenience store. The company quickly began growing across Quebec, and he led the company through numerous acquisitions across Canada and then globally. Over the past 4 decades, the company has developed a reputation as a very successful acquirer and allocator of capital. And this is demonstrated by the substantial synergies that they've created in their large acquisitions in the US, such as Circle K and CST and Total Energies in Europe. In some cases, the company has courted acquisitions for almost 20 years until they've been completed. So in this situation, you need a leader who can foster these relationships over the long term and execute their long-term vision in order to succeed. We fast forward to today, Couche-Tard has over 17,000 locations and about 150,000 employees. Mr. Bouchard was CEO for the first 35 years of the company and now acts as executive chairman, where he oversees acquisition opportunities. He still owns about 11% of the company, and we believe that this alignment with shareholders, his long-term vision, and operations experience have all helped himself succeed, and as well as the company and its shareholders over that time period.
And here's some additional context on Couche-Tard from Thom of Moat Financial.
When we look at founder-led companies, especially sticking inside Canada, there's none that we like more than Alimentation Couche-Tard. Alain Bouchard, he started this company. You know, he's not in the CEO role, hasn't been there since 2014, but obviously still plays a huge role in the short-term and long-term strategies that this business takes. We like the fact they've grown in a really competitive business from nothing 45 years ago, and now are looking to buy 7-Eleven. So, we can only imagine that at some point 30 years ago, they were in the boardroom and said, we will buy 7-Eleven someday, and everyone would have thought they were crazy, and now it's happening. So, we really like this business. We think it's at sort of the lower end of its range because it's been under pressure due to this acquisition, but, long term, it's going to add value.
Stock number 2, Aritzia.
Yeah, this one comes from Ticker Take regular Jamie Murray of the Murray Wealth Group. Here's more from Jamie.
It was founded in the 1980s by Brian Hill. He still remains with the company in the executive chairman role, even though he did cede the CEO role to Jennifer Wong a couple of years ago. But Brian is still intimately involved in the real estate strategy and fashion strategy for the company. Obviously, two very important pillars for the company's success. Now, this is a company that we still think has an extremely long growth runway in the United States, where revenue was up 48% year over year last quarter, and then moving internationally where it's barely scratched the surface. And for a fashion retail company, it has very strong cash on cash returns, return on equity, all the financial metrics that you love to see. It's a very disciplined management team when it comes to growth and running the business. And so this is one that we're going to continue to hold here for a long time.
Stock number 3, Constellation Software.
This one comes from Jason Del Vicario of Hillside Wealth Management at IA Private Wealth. And Jason really leans into founders as an investment opportunity. The fact that they are mission driven, think long term, invest smartly, reinvest smartly, try to protect culture. Here's Jason on Constellation.
It was founded in 1995 by Mark Leonard. And unlike most tech companies, Constellation didn't chase headlines or burn cash. Instead, Leonard built a company focused on acquiring small niche software businesses and keeping them forever. Even today, 30 years later, Leonard still chairs the board. He and his team own a big chunk of the company, and that matters. Because when people running the business have their own money on the line, they think like owners, not just employees. They don't worry about pleasing Wall Street every quarter. They focus on the long game, making smart acquisitions, growing cash flow, and reinvesting wisely. That's why Constellation has been one of Canada's best performing stocks. It's not flashy, it's focused, founder-led, and built with discipline. For retail investors, that's rare and incredibly powerful. Constellation Software shows what's possible when a founder with a vision stays involved and treats shareholders like partners.
Stock number 4, Meta.
Well, on average, Facebook's parent company is liked by a majority of the analysts on Wall Street. We decided to speak to an analyst who doesn't officially cover the stock, but knows everything you need to know about social media companies. Debra Williamson has been tracking the Meta story for years. And when it comes to founder decisions in technology, you've got to have vision. You got to be thinking about big moves that people might not understand in the moment. Here's more from Debra.
The company has pivoted several times. So, for example, from being a social network platform that was primarily on your desktop computer, transitioned to mobile, which ultimately created immense new opportunities for Facebook to, as a company, to bring in new types of revenue, ad revenue, and to help businesses, large and small, make that transition to the mobile era. The next one was video. Meta embraced video with Instagram and on Facebook and those two platforms particularly. Video is now an integral part of social media. It's not just talking to friends and coworkers or people you're connected to. I also would put creators in that bucket. So pivoting again to embrace creators and the kinds of relationships that they have with their audiences. And that brings us to today. The AI era is here. And Mark Zuckerberg, I mean, you could argue that his pivot into the metaverse maybe wasn't so smart, but what was really smart was that he realized that and completely embraced AI. And I think his decision to double down on AI is showing results, right? I mean, the stock, it did go through some gyrations earlier this year because of the tariffs and some concerns about capital expenditures, which, haven't gone away. But overall, I think investors have come around to the idea that this is a leader. Mark Zuckerberg is a leader that has been able to pivot the company through multiple major tectonic shifts, and not only react to them, but actually be a leader in some of those areas. And I feel like that's what's giving Meta the momentum to move forward in the AI era, and what gives investors confidence that someone like Mark Zuckerberg, despite the flaws that he might have, but overall the leadership that he's shown is something that they believe in.
Stock number 5, Novo Nordisk.
Novo Nordisk is the parent company of Ozempic. Before we get into the stock, this is from Darren Sissons of Campbell, Lee, and Ross, who has found a lot of examples of companies with ties to founders in North America that have encouraging businesses, American Financial Group in the US, CGI in Canada, but he's been a longtime investor in the European market. So finding companies like Kuhn & Nagel or Lindt with ties to their founding families. And he's also identified there are some companies in Europe where the founder stake or a portion of the founder investment ends up in a foundation. Now, Novo falls into that category. The stock has had troubles over the past year. He was an earlier investor in the business. Here's his perspective on Novo today.
So we've owned it since the year before, just before President Trump became the first time around. So if you recall, what happened was Hillary was going to effectively tax pharma and things like that. So all the drug stocks sold off. We bought it then and we owned it, and we've trimmed it 7 times. In the last year, really this year, it has given back some of those gains on the back of some gains its major competitor Eli Lilly have done. But we're for every dollar of investment we've got, we're playing with about 14 cents. So it's been huge. So we still own that. In fact, we added to it just recently because we think at these levels, given that it currently has the best product in the market until the end of the year, and it's still growing at double digits in a double-digit growing market, it looks very, very cheap.
Stock number 6, NVIDIA.
This is a second pick from Jamie Murray of Murray Wealth Group. We've talked a lot about NVIDIA on Ticker Take, but less so from the perspective of its founder. Here's more from Jamie.
It's still led by its founder, Jensen Huang, one of the only large technology companies that still has its founder full-time in the driver's seat. And it's not just riding the AI wave, it's literally creating it. So NVIDIA's GPUs are powering a new wave of computing. We've moved from the training phase into the inference phase, which is millions of people, millions of users around the world running these models, generating real world results. And we're moving into a world of expanding use cases for these models. So not just writing your wedding speech anymore, we're moving into autonomous vehicles, robotics, and high precision medical technologies. And so NVIDIA is the company that's powering all these. The stock's been flat over the last year. We think now is a very opportunistic time to get in. Revenue estimates for next year are actually up 30% over the last 12 months. And that's not reflected in the stock, and we think it's going to continue to move higher.
Stock number 7, Severia Corp.
This one comes from Neela White of Blue Wing Advisory Group at Raymond James. Neela has been a longtime investor in the trend of aging populations. In this case, though, the stock investment has a founder connection. Here's more from Neela.
It was founded in 1989 by Marcel Bourassa, and in 2002, the company went public. Today, it is still run by the Bourassa family. It is a global leader in accessibility products, manufacturing everything from home elevators to stair lifts, wheelchair lifts, and that would be their patient accessibility products, as well as patient care products, which encompasses hospital beds, ceiling lifts. I think patient care is going to continue to be a growing segment of their business simply because of our demographic tailwind and the issues that we're having within our healthcare system with staff shortages. They have 15 plants around the world. They're quite innovative as far as their production goes. One of their newest features has been called the Luma through the floor lift, which doesn't require a support wall, and it's highly placeable and flexible on where it can be in the house. And again, it's one of those things of when we look at homes today and we look at issues that we may have going upstairs, most bedrooms and bathrooms are upstairs, kitchen on the main floor, laundry room possibly main floor or basement. Well, when you have trouble with stairs, but you're not in a position to either move or you're ready to downsize, this would be one of the accessibility products that allows you to maintain independence and continue to age in place. They've expanded their facilities in the US. So currently in South Carolina, they have a 60,000 square foot manufacturing plant. They invested $30 million more to increase that space by an additional 55,000 square feet. Their products are USMCA exempt. So as far as the tariffs go, there is minimal impact. And for that reason, I do like Severia as far as being a little bit more insulated, as well as one of the other things when we look at theme and thematics is one, they're supporting the aging demographic, which in general is a tailwind, as well as the movement right now is aging in place. So what can we do to make our homes more independent and safer? And they do cater to projects such as those.
Stock number 8, Shopify.
This one comes from Hatem Dhiab of the LA-based firm Gerber Kawasaki. He's been a longtime watcher of technology stocks. He likes when founder businesses benefit from moving fast, having smaller teams focused around product, and he sees a lot of that with Shopify. Have a listen.
When you asked about founder mode, Shopify came to mind first, right? Because here's a company that's very innovative and then experienced tremendous growth post-COVID, right? And they got really kind of almost not confused, but got, stretched in different areas and started doing logistics and, grew to a point where they lost focus in many ways. And you got Toby Lutke, who's the CEO, who kind of really came back in and just really took over and was like, hey, listen, we need to focus here, right? And founder mode really speaks about the fact that you focus on smaller groups, smaller teams, right? Get more technical. So focus on the technical abilities of the company, right? Versus the managerial or the corporate structure that kind of gets created once you experience the growth they've experienced. And they were very good at it, right? When Toby got re-involved back a few years back, they saw the logistics portion to Flexport and then really focused. For example, they embraced AI in a way that no other company has.
Stock number 9, Sprouts Farmers Market.
This one comes from Burt Flickinger of Strategic Resource Group, who knows retail as well as anyone out there. Here's some perspective on Sprouts.
Albertsons refused to buy them at $20 a share 3 years ago, thought they were quote unquote too overvalued. The founding families were still involved. Why not have corporations take it over, run it more efficiently, more effectively, take the size and scale combined with Sprouts' skill? Well, Albertsons never bid more than $20. You check your Bloomberg terminal today, Sprouts Farmers Market is $175 a share. So close to 900% gain for the shareholders in less than 1,000 days. And our Strategic Resource Group forecast is it's easily going to reach its 52-week high of $220, which got contracted during the last stock market contraction. The founders came from nothing, blue-collar families working 2 or 3 jobs to capitalize and get the business and get 5 different families, founding families to combine, Boney's in San Diego and a number of others to found Sprouts. They brought in Jack Sinclair from 99 Cent Only and brought in the best and the brightest from people who couldn't stand the Dutch masters who were running Ahold Delhaize and Stop and Shop and Giant. So they recruited the best people who were disenfranchised at businesses that weren't founder-led and said, we're all going to own and operate with the founders, and we're going to have the best prices. We're going to give the best support to the local entrepreneurs, the local farmers, the local vendors, and support key community philanthropy. And we're going to make the store easy to shop. Instead of carrying 50,000 items, we're only going to carry 5,000 items, and the quality is going to be the highest. The food value and nutrition is going to be the best. And we're going to raise people's standards of living because 70% of people are living paycheck to paycheck and can't afford to pay their 12 monthly bills, which are the highest in history. And now they're coming to Canada and going North American because they're doing such a good job buying old bankrupt stores for next to nothing at 25, 50 cents on the dollar and converting them. So the cost of rent's the highest in the business. And so their cost of rent's the lowest. The cost of energy is the second highest in the business. And because they go solar, their cost of energy is lower than everybody else, including Wegmans, which refuses to do solar. And finally, cost of labor, because they're non-union and they get much greater efficiency and effectiveness and productivity from their people who share in the profit, whether they're founders or not, they're equivalent ESOP holders. They win.
Stock number 10, Strathcona Resources.
This one comes from Cole Smead of Smead Capital Management, who is constantly keeping his eye on the founder opportunities, particularly in energy, because he's seen a lot of them over the years, whether it was businesses like Tourmaline or Canadian Natural Resources, or now with Strathcona. And he's particularly impressed by the founder, a former investment banker in Hatem Waterous.
Hatem's unique in that he used to advise all these people. He's a former banker that sold his M&A advisory to Scotiabank, became the global banking chief, steps down from that and starts this business in Strathcona. And where he's different than a lot of these other players is that he is just a capital allocator financier. So truly like a holding company, chairman, much like Warren Buffett's been for many years at Berkshire Hathaway. He doesn't actually operate wells. That's not his calling in this life. So they tend to leave the operators in place, much like Buffett would leave the companies in place and their management to run that business. And that's what Hatem's doing. I think what's keenly interesting about Hatem relative to other people is he's just being more aggressive. The first time I ever met Hatem was a couple summers ago. I was being highly naive, by the way, John. If you meet a private business at a sell-side get-together, you know they're not going to be private for very long, which is kind of funny. I was just being stupidly naive. But I will say this. What you get with a founder-led business is they're going to give you their vision. They're going to give you their vision of where they're going and where they think the dynamics are at. And they're going to be very open to communicate that because they think a lot about that. And as soon as I heard what Hatem had said, very constructive, long-term bullish, thinks supply is going to be tighter longer term. And he thinks it's a very good business to go out and make money. But he knows that historically it's been a terrible business with a lot of volatility. And he's fine with that volatility. I turned to my colleague at the time and I said, listen, if this guy ever goes public, I got to own him. He totally thinks like we do. And the reality is he went public via Pipestone 60 days later. But here he is now doing something highly aggressive. He's selling Montney assets. And part of that, by the way, he sold to C&Q. Part of that, he also sold to Mike Rose at Tourmaline. He was effectively selling gas assets. Gas assets are very well liked because we all know that AI is going to use a lot of electricity. And natural gas is the primary way to create electricity in this world. Well, the problem is the oil business is being left for dead. In comparison, so what is this great capital allocator, founder-led entity doing? They're arbitraging gas assets relative to oil assets, which again, that's a scarce bet that's being laid. We think about it just like him. So it's weird. What's weird for us as investors, and something like, the great part of public stock markets is this is publicly available. This sits out there. Anyone can buy it. The small investor, the big investor, anyone can. But the difference in this is that he has the framework that we have, and those kind of things where you think, oh man, if I got to do that, here's what I would do. That's what Hatem's doing. He's taking and being aggressive. He's using his leverage from selling those assets to go out and acquire Meg now. That deal is out there. There's a lot of discussion whether that's going to get done. But again, it's the aggression. I jokingly call the oil business, we're in the low T era, or known as low testosterone era, because ultimately these are operators, but these are not financiers and investors. And what they lack is that investment acumen. That's exactly what Hatem brings to the table.
And stock number 11, VeriSign.
Yeah, this one comes from Matt Weinschenk of Stansberry Research. And Matt generally embraces what founders can offer, vision, determination. And in the case of this company, an investment that Warren Buffett's Berkshire Hathaway has been interested in as well. Here's Matt.
It was found by Jim Bezos back in 1995. It was a part of RSA, which is like a big internet security company. And what VeriSign does is it's really like a backbone company of the internet. If you are registering what are called top-level domains, so that's anything with a .com, a .net, a few others, VeriSign manages the ownership and the registration of all those domains, and then it has to maintain these special servers with super high reliability so that people can actually access all these websites. So this isn't like a marketplace where you buy a domain name when you have a business idea. It's like it's underpinning those. And so there's 170 million .com, .nets, and some other ones that VeriSign manages, and they each pay $10 a year to VeriSign, and which doesn't sound like all that much, but comes out to 1.5 billion in revenue, and the business is so simple that it only has 900 employees, right? So that's 1.6 million in revenue per employee, and it leads to these just incredible profit margins, 70% profit margin, and then out of 1.5 billion in revenue, they generate 900 million in free cash flow, right? Now they're plowing back in. They buy back about 6% of their shares every year. They just instituted a dividend this quarter. And so that's the company. But like, what's special about the founder story? Well, this company is, you know, there's no biographies about Jim Bezos. He's just a quiet guy. He just goes to work. He gets the job done. He knows the company really well. He actually stepped down from the CEO role for a stretch after founding it. And he came back in 2011, and that's when you see the share price start to tick up. So this isn't like a stock that's going to surge, but it's returned 15% a year for the last 10 years. And if you watch the revenue, it just ticks up, up, up. You watch the earnings, they just tick up, up, up. So just a real steady operator, owns a ton of shares, doesn't have, you know, I don't think he has a private jet. I don't think he just seems to really care, really keep it simple. They don't branch out into crazy projects or things like that. He just knows and seems to really love this company. And he's just been running it for a long time for the benefit of shareholders, which is because he's such a large one.
All right, that's our list of stocks with a founder factor.
Do you like any founder-led companies? Let us know in the comments.
Absolutely. And if you liked some of today's guests, we've got more information about them all in our description, where we also have a link to our weekly investing newsletter. It is free, and we have all sorts of investor takes in that.
And please help support our channel by liking, sharing, and subscribing. We are founders too, and we could use the help.
Indeed. Thanks for watching. See you next time.